Close your eyes for a second. Imagine you walk into a bank. You deposit your hard-earned money. The screen shows your balance. You feel safe. Now here's the uncomfortable truth. The moment that money hits your account, it is no longer legally yours. And almost nobody knows this. This matters right now because trust in banks is taken for granted until it suddenly isn't. History shows that when people finally ask this question, it's usually too late. So let's slow this down. No jargon, no finance lectures, just the real story. When you deposit money into a bank, you don't store it there, you lend it. That sounds dramatic, but it's literal, legally, in most countries. Your bank account is not a vault, it's a promise. The bank owes you money. That's it. You become a creditor. The bank becomes the owner of the cash. And like any borrower, the bank uses it. Your money is immediately put to work. Loans, mortgages, business credit, government bonds, sometimes things you would never personally agree to. This is called fractional reserve banking. But forget the term. Here's the simple version. If 100 people deposit money today, the bank keeps a small slice and lends out the rest. Not next week, not slowly, immediately. So when you check your balance, you're not seeing your money sitting there. You're seeing an IOU. Most days, this system feels invisible because it works. You swipe your card, money moves. Everything feels solid until everyone wants their money back at the same time. That's the one scenario the system cannot survive because the bank does not have it. This isn't a conspiracy. It's design. Banks are built on the assumption that you won't all panic at once, and usually they're right. Now, here's where it gets uncomfortable. If a bank fails, your money doesn't get first priority. The bank's assets are sold, debts are settled, big institutions go first, other creditors line up. You are just one of them. Yes, there is deposit insurance,
but that insurance is not a vault either. It's a promise backed by governments. And governments back promises with more debt. Irony noted. So who owns your money? Not you. Not fully. You own a claim, a number on a screen, a belief that the system will keep working tomorrow like it did today. This system exists because modern economies need constant motion. Idle money is considered a problem. Banks turn savings into fuel. And for decades, it worked beautifully. Growth, credit, rising living standards, but it also created something fragile: confidence. The entire structure depends on people not thinking too hard about where their money actually is. The moment confidence cracks, things move fast. We've seen it. Bank runs, frozen withdrawals, emergency bailouts over a weekend. And every time the same shock. I didn't know it worked like this. Here's the quiet twist. Banks don't hide this. It's written into law, into terms you never read, into a system designed long before mobile apps made money feel instant and permanent. We were taught to believe money in a bank equals safety, but safety is conditional. It depends on trust, stability, and time. So the next time you open your banking app and see that number, remember what it actually represents. Not ownership, but permission. Permission that can be revoked, delayed, or redefined. And that leads to a final question worth sitting with. If your money only belongs to you as long as the system stays calm, what does financial security really mean anymore?